Hey, what's up? This is Greg. I am here on Friday, August 4th, and I'm doing my market update here in the woods. I thought it would be appropriate on a Friday afternoon after the market closed. So what I want to do today is just talk about pretty much, the main things that went on in the market this week, and then give some thoughts at the end and try and connect the dots. Hope that makes sense for you. Okay, well, I'm going to walk a little bit. I'll stop and periodically, and hopefully this will all work out. But okay, so the market this week, the stock market did okay. It had an okay week. The major indices were flat except the NASDAQ was up, so it continued kind of an uptrend. Some of the up days were pretty pronounced, so a lot of people are starting to think that that we might be out of a bear market, and there's still, to me, a lot of bullishness around, and everything was kind of going in that direction until this morning. They announced the job market, okay? And the job market surprised significantly to the upside. And according to the government, the economy produced 528,000 jobs in the month, okay? Now that, to everybody, including me, sounded like an insane amount, because it's basically double what people had expected. And it caused, at least in today's action, it caused people to kind of get a little concerned, because bottom line is it indicates that the economy is overheating. So whereas in the last couple of weeks the concern was that we were going into a recession, you saw the bond market, especially at the long end of the bond market, yields were going down. But today you saw that 10-year and really across the board yields went up. So basically, in my mind, what the bond market is basically telling you is that they are now, or at least today, we're concerned that this would mean that the Fed would continue to tighten, continue to raise interest rates, and basically that the Fed really means what it says when it says that it's tightening credit and raising interest rates. Now, this situation is really perplexing, and there were a lot of people on CNBC and Bloomberg and various channels. A lot of the commentators were coming on, and it seemed like everybody was surprised at how high this number was. I mean, it was basically twice what the market had expected. And, when you try to connect all the dots on this, it really is perplexing, because it's stuff, okay, so it looked like the economy was softening. We had 2 consecutive quarters of contraction in the GDP. And now, all of a sudden, the economy produces 528,000 jobs, and the unemployment rate ticks down. Like, how can this be? How can the economy be contracting when the economy is creating that many jobs? I mean, it really doesn't make sense. I mean, it almost makes you think, I said to someone earlier today, kind of makes you think, are these government numbers even real? Are they just making them up, or exaggerating them to make the economy look better for political reasons? I mean, that seems unlikely. It seems impossible. But when you try to connect all these dots, a lot of stuff really does not make sense, okay? And so I personally don't think that if the economy is truly contracting, how can it create that many jobs, all right? Now, the other thing to consider is that, and I've talked about this, the participation rate among workers is only 62%. That means that only 62% of the able-bodied people that can work are actually working in the labor force. So, you know, that is a day that makes it even harder to understand how this could be possible. So you have all of that going on. Then you see a lot of people jumping into the mega cap tech stocks. And if you've been watching this channel, you would know that I recommended several months ago to go into Google. So I'm kind of on board with that. And I bought Alphabet before the 20-for-1 stock split. I bought 2 tranches of it. And so far I'm up about 10%. Did lose the connection there for a second. Went on to go off Google before the 20-for-1 stock. And everybody's been jumping into the mega cap tech stocks. And that shows that people are going from value into growth again. And, you know, that all kind of makes sense. If the economy is slowing to do something like that, that would make sense to be in growth stocks. We've talked about that on the channel. But the difficulty that I'm having in general with this is when you try to connect all the dots, something is really wrong here. And this employment number just completely blew me away when you try to reconcile it with the rest of the things that you see in the market. So, you know, as I sit here, as I've talked to people, both, you know, on the channel and with comments that come in, I still think we're in a I think that the rallies you saw this week were rallies within a bear market. I don't think that the overall direction of the market has changed because the Fed policy has changed. Okay, those who believe that the economy softens significantly, the Fed is going to back off and even potentially start to ease again and lower interest rates. In other words, they're not serious about what they're doing. Those who believe that you know, those who believe that think basically that the Fed is not serious. And I think the problem with that reasoning and the problem with that thinking is that the Fed has to be serious because the amount of inflation that we have, which is getting embedded in the economy, is almost unprecedented, except if you go back to the 70s. And so the Fed has no choice but to continue to raise interest rates and continue to withdraw liquidity from the markets and the economy and tighten credit, also known as quantitative tightening. And as long as the Fed is in that kind of a stance, and you're not just, you know, pretending that they're not doing it or hoping that they're not doing it, we're going to be in a bear market, and the overall direction of the market is going to be down. You know, having said that, this is a very unusual set of circumstances. I would argue that we've really never been in this position before. We've never been in this place before because we never had such an explosion in modern monetary theory along with the fiscal spending, which has been unprecedented, along with the keeping rates at zero, with the Fed printing money, the Fed buying securities, the Fed flooding the markets with liquidity, causing all kinds of distortions and bubbles in the market, which we're now seeing unwind. So it's tough to navigate through this, but I think if you want to err, you should err on being conservative because we just don't know what's going to happen over the next year. And I think come this fall, with the seasonal situation that we normally have come September and October, it could get pretty ugly in the stock market. I've said all along that you can a stock picker, you can selectively go into stocks that you believe or companies that you believe have really good prospects, even in a slow economy like Google, like Apple. But other than being a very selective stock picker, I'm still bearish. I'm still bearish. And one thing to keep an eye on is when you're trying to figure things out, definitely look at the bond market, because the bond market often discounts 6 to 8 months ahead of time. And I thought it was interesting today that the bond market reacted so quickly, going from, around, what was it, 275 up to, 290, like relatively quickly, 285, whatever it was. Very quickly, which means that they're concerned that there is more growth in the economy than was previously thought, and the Fed will have to be more aggressive in its money tightening and interest rate raising. Okay, now the only other thing I wanted to talk about on this live stream was just that all of this stuff, all of this uncertainty that's happening in the markets is happening again against the backdrop, and this is something else that changed this week, against this kind of resurgence of Biden's Build Back Better. I call it Build Back Badder. Nobody else has picked up on that, but I coined that phrase a few months ago. Nobody picked up on it. I'm kind of surprised. But this Inflation Reduction Act, which I've said on this channel, is it takes a lot of balls to call it that, I'll tell you, because all it is really is corporate welfare to green energy companies. It's a minimum 15% tax to corporations, right? There's going to be taxes in there to individuals. Yes, that means you're going to pay more money. You, me, everybody. And it's going to hurt the middle class. And they basically bought off Manchin by giving him some permit assurances on a pipeline that's going into West Virginia. So they basically bought him off to get him to agree to this. It's yet another tax and spend plan. $369 billion is going into green energy, which is basically corporate welfare. $80 billion to the IRS, so that they can have more people and more resources to come after you and me and everybody else, so they can glom more money off of you. That combined with the chip bill, which was another $250 billion. The government is just, if they get this passed, the government is just, continuing to spend like drunken sailors, and I don't mean to insult drunken sailors. So if you're a drunken sailor out there, I don't mean to insult you, so don't take offense by that. But this is close to $1 trillion of additional government spending. I mean, it's like these people never learn. It's absolutely insane. And for those of you who are listening who might be, big into wasting a lot of government money and government subsidies on green energy. I shouldn't say wasting, because you probably think it's, money well spent. Even if you believe that, you should still hate this bill, because it's got a lot of incentives in there for oil and gas companies. And so it really violates a lot of what Biden and his cronies have been preaching the whole time. So it's really got a lot of stuff in the bill. If you're cognizant, or if you want to spend any time really understanding what's in the bill, there's something in this bill for everyone to hate, okay? Regardless of which position you have on green energy or fossil fuels or whatever. So, I was going to say, I thought I got a comment there, but I guess I didn't. But so anyway, to sum things up here, because I don't want to make this too long, but to sum things up here, the market had an okay week. It was really relatively uneventful. The only two things that really happened was this employment number at the end of the week, and also the resurgence of Build Back Better sub 2, the Inflation Reduction Act, which I almost laugh hysterically every time I say that. So, you know, it's kind of like the doldrums of the summer. Things are you know, relatively dead. When September comes around, everybody comes back from the Hamptons, and people start focusing again. Things are going to get a lot more crazy, I believe, and look to a lot more volatility and increasing volatility in the September-October time period. And what I will do on this channel is continue to update on the market and on the situation, and try to connect the dots, even though it's very challenging, and even though there are no clear answers here, because we've never really been in this situation. Okay, so that's what I wanted to say for today. Have a great weekend. If you got value out of this, please like and subscribe. And the purpose of this channel is to make you a better and hopefully richer investor. We talk about the markets, we talk about economics, we talk about all aspects of investing. We make specific investment recommendations on this channel, and you can catch all of those and get notified if you are a subscriber. And so that's what I wanted to say today. Thank you very much for joining, and have a great weekend. And we'll be having some more videos coming out very soon for your enjoyment. I'll see you on the next video. Okay? Take care. Have a good one.